Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. Tuesday, March 14th with the Moose, John Mousseau, President, CEO. We wanted to have a special update today, really to have a discussion on some phone calls we've been getting, and rightfully so. Clients, friends, colleagues, concerned about headlines, concerned about safety of assets, whether it's cash or securities. So we wanted to spend 3 or 4 minutes just going over some of the details at Cumberland that we pay attention as a fiduciary to try to take that safety into consideration. First off, Cumberland is an RIA, a registered investment advisor. We use a custodian. Whether that custodian is Schwab or US Bank or Ameritrade, they fall under the SEC's Consumer Protection Act. What does that do? That forces them, John, to segregate client securities from the bank or broker-dealer's balance sheet.
Right. Totally separate.
Totally separate. When we deal with a separate account, as you would have, let's just say, Schwab is your custodian and we're your investment advisor. Schwab isn't able to commingle those securities with their own balance sheet, separate. That's your securities, and that's bonds, stocks, right, ETFs, mutual funds. Cash is another item we've been getting some calls on. At Cumberland, we spend a lot of specific research on where to park your cash. In terms of cash that we use as a parking spot for you, our cash sweeps, which are a money market, we call them sweeps because when you sell a bond or a bond gets called or a stock gets sold, the capital flows into a money market. The ones we use are either FDIC insured or they are a fund of short-term treasuries.
Correct.
30, 60, 90-day treasuries. Very liquid, backed by the full faith and credit of the U.S. Treasury. So when we talk about inflows and outflows and runs on banks, I think it's important to differentiate how your money is treated versus at a bank where you may be over FDIC limit and that bank itself has 90% of their customers over FDIC limit,
right,
thus causing a run on the bank. Not seeing that at our custodians at all. As a matter of fact, our custodians are seeing heavy inflows. Moose, talk a little bit about some of the programs that were put in this weekend.
Yeah, what you saw this week, and this happened over the weekend, you saw the Federal Reserve step up to the plate. And when you went home Friday, it looked like the only depositors, and that's the big distinction between our investors who are investors with a segregated account and a depositor at a bank, which is a different animal. Deposits over $250,000 were not insured. Under $250,000, FDIC insurance. Believe me, lots of millions and millions of dollars in these two banks that were in the uninsured category. Federal Reserve, afraid of the cascade effect. Very real. Somebody can't get to their money. Suddenly, a company can't meet a payroll. Then suddenly people can't get paid. They can't spend money on things. And the whole thing has kind of a downward spiraling effect. The Fed didn't want that. It had nothing to do with, the quality of the assets that the banks had.
Very different than 08.
Very different than 08 when you had bad mortgages and things that were illiquid. These are liquid securities that had gone down in price because interest rates rose. So what the Fed did is they went in and said, you have a lot of these long treasuries and agency securities that you bought at par that are worth 65 cents on the dollar. We will accept par, 100 cents on the dollar, as a collateral to give you loans to meet the deposits that are out there. And that, in one fell swoop, helped save the day and put confidence back in the system. Does that mean there's not more banks are going to have some issues? No. But it did put a floor on the turmoil that we saw over the weekend.
On Friday, the headline in our weekly wrap on the markets was cracking confidence.
Right.
And just to circle back to that, markets are about confidence.
Absolutely.
The confidence that what you trade can settle, what capital that you have invested has some form of liquidity, some form of safety. Now, that doesn't mean the security prices can't go up and down. We're talking about the safety and liquidity of the capital.
Right.
So just 3 points to keep in mind going forward when questions do come up from a custodian standpoint within our firm. Your securities, stocks, bonds, ETFs, are segregated into a separate account. They do not sit on the bank's balance sheet, number one. Number two, the money markets we use fall into two categories. They're either FDIC insured or they're short-term treasury bill money markets backed by the full faith and credit of the U.S. government.
Right.
The third thing is a little trickier to keep an eye on, and that is just be aware of inflows and outflows to banking institutions.
Right.
The banks that went under were primarily invested in long-term treasuries, as John mentioned, credit good, but poor duration management.
Right.
Matt borrowed short, invested long at the wrong point in the market going back a couple of years ago.
And so what erodes? Because of what the Fed's doing, raising short-term rates, they're paying more and more on the deposits, their liabilities, and their assets are declining in price because of the rise in yields. That is a toxic formula.
Right, right. So thank you for joining us for a few minutes. If there's further questions, feel free to reach out. This special update is something we felt was necessary just to help people understand what we're looking at day to day. We'll see you on Friday afternoon.